Our first panel will take a look at capital. We're going to talk about capital and what's been going on in that world. Real Capital Analytics indicates that in 2015, global cross-border capital was about $425 billion. In 2016, last year, it dropped to $350 billion, is estimated to be back up to $375 billion. So there's a lot, as we all know, a lot of activity going on, a lot of cross-border activity going on. And so to lead that discussion, I am delighted to introduce Megan Morris. Many of you have read Megan's work if you read PERE publications. So Megan, we're thrilled to have you here. And she's going to lead the discussion about debt, equity, and innovation, how global capital influences future development. And Megan, I'll let you introduce your guests.
Thank you, Steve. I can bring them up on stage right now. We have a very interesting group of panelists today with us from all corners of the world, and they equally invest in all corners of the world. So I think this should be a very robust discussion looking at what's going on. You can join me on stage up here in any order you wish. Thanks. As they come on stage, I just want to remind you, if you haven't downloaded the MIT app yet, you can do so. You can also hop on the Wi-Fi, so that makes it easy. As much as I, as a journalist, love asking questions, I would also love to hear from you about what's top of mind. And to do so, I'll be monitoring this iPad throughout the discussion to make sure that I'm answering all of your questions. So you can send those in through the app. And then if you want to shoot up a hand, that's great, too. I'm seeing some familiar faces in the audience. So I'm looking forward to bringing this discussion to stage. So just to start off, I would love if we could go down, starting with Christina, to talk about who you are, what your firm does, and where in the world you're investing these days.
Sure. So I'm Christina Gore from Gore Capital. So I came from Hong Kong, just arrived last night, to obviously just heard an amazing speaker talking about the future, and it relates to our business, real estate. So I'm a private equity real estate investment firm. The firm started investing in Asian real estate. But since then, from 2005, when we started the firm, founded the firm, we have grown globally and invest in global real estate now. We mainly focus on actually all segments of real estate, but in a very creative mind. So the business is owned together with my two older brothers, Goodwin Kenneth, myself, and another partner, Humbert. That's sort of the brief overview.
Excellent. And one more question to add. Who is your investor base? We have some very different sources of capital on stage. So who typically invests with you?
So about 80% of my investor base are institutional. So they include global sovereign wealth funds, global pension funds, university endowments, and of course the usual family offices and foundations.
Great. Thanks.
Me. My name is Roger Orff. I'm based in London and lead Apollo Global Management's efforts to invest in real estate internationally. Our current fund's about $4 billion of equity. We're focused on our fund principally in buying European NPLs and real assets. I moved over to England in 1990 with Goldman Sachs, and over the years became a British subject. So, despite my accent and despite Brexit, I'm there for the long term.
My name is Rodrigo Nino. I am Colombian of origin. I'm living in New York. Excuse me. And we focus on commercial real estate property for now in New York only. And we have an average ticket size of less than $10,000 now. We have investors in 29 countries, and we expect to grow to an investor base in 116 countries with an average ticket size of $1,000 in the next few months.
Well, my name is Luis Pereira. I am the executive chairman of a company called Grupo Lar. It's a Spanish company. We work in 7 countries, 3 in Europe and 4 in Latin America. We are private, though we externally managed a REIT in Spain for commercial real estate. And we are developers, we are investors, and we are asset managers as well.
Thanks, all. One of the things that is top of mind for many of us in the room is how politics is influencing global capital flows and investment strategies. We were talking a little bit about this over breakfast this morning, about Brexit. So, Roger, could you kick us off and just take us through how Brexit has changed what Apollo is doing, and then could chime in with some other political influence kind of strategies and what's top of mind for your individual firms these days as it relates to politics?
Sure. Firstly, as I guess everyone in the audience knows, Brexit, the advisory vote occurred last June, and Theresa May formally exercised Article 50 in January, and we're now in this process of an election, which I think is occurring sometime in, I believe it's the 9th of June, to see whether or not she gets a stronger mandate than what she currently has to evoke what she says will be a hard Brexit, which I think essentially means that she's saying the UK wants to restrict immigration, and in return for that, we are out of the common market. And so my view is that that means there'll be a free trade agreement akin to what Canada has with Europe, and I think that's going to take a long time. I think that would take about 5 years. And it's led us, the consequence of that in the UK at least, from our perspective, is a lot of what we do was in the southeast. We bought £1 billion worth of rental residential property, and we've been somewhat active buying office property. And I think we're much more cautious now on investing in the southeast, because while over the short term, the economy's held up reasonably well. As many of you know, part of the reason for that is the currency collapsed from about 1.45 to the dollar to 1.2 to the dollar. And I think some investors are looking at that and saying, I'm getting things cheaper on the currency perspective. But the underlying fundamentals in London are deteriorating in terms of office rents and in terms of residential rents. So we're looking at it a little bit cautious. I think that London's a great place. Over the long term, it's a great place to be making investments. But I think that when I look at the UK, I think there's three big issues going forward over the long term. One is foreign direct investment, if you leave real estate aside, is slowing down. So people are just, it's an uncertain time. People aren't putting plants there at the moment. Two is immigration. If you restrict immigration, you restrict your GDP growth. I was telling someone earlier, when I was growing up in America, there were 200 million people. There are now 330 million people. And UK is much smaller, but statistics suggest that if we invest, if there are less immigration, that's 50 basis points of less GDP growth. And finally, in free trade agreements, they often don't include financial services. So if you regard financial services as the crown jewel of the UK in terms of what's embedded in London, I think at the margin, we're going to lose out.
Luis, what can you tell us about what's going on in Latin America right now, given that there is probably more external pressure directed toward some of the countries in which you invest? What do the kind of political headwinds look like in terms of your investing strategy?
Latin America is a big part of the world, and I don't pretend to understand all of it. It is very complex. And the beauty is that always there is some country in which we are, which is in trouble, and there is also one in which we are making some money. In terms of the challenges that we had, last year for us was the year of Peru. There was a change of the president, as you know, with new policies after quite a long time of the Humala rule. And so we thought it was the moment to invest, and we did. Unfortunately, all the Odebrecht scandals is not helping very much the country, but still, I think that PPK, as he is called, will take Peru into a new era of growth with incredible natural resources, I think. In Mexico, where we have about 1/3, even a little bit more of our investment in Latin America. The issue is not, I don't think the issue exactly is the wall, but the issue is that the elections we are going to have next year. And Mexico is very peculiar because the way that the president is elected is in one vote. That meaning that you can be president with 30% of the total votes. It's not the French system. And depending on who wins, it will make a difference in terms of confidence for the country, and that's going to come next year. And you know, it's unclear to me in this moment which will win, and that for me is much more important than how NAFTA is going to be renegotiated in the next months. And then you have Colombia and Brazil, the other two countries I know a little bit. Brazil is getting much better. I mean, Brazil had an interest rate of 14-25% a year ago. Now it's 12. It's going to go probably to 8. And the problem in Brazil is also the same as in Mexico. There are elections in next year. As you know, Mrs. Dilma was ousted by impeachment. There is a new government, weak government, with a good finance minister, and Mireyes. And now the question is whether those reforms that are driving a new situation for the country will continue or not. And all this Lavallato problem is there every day. I am very optimistic about Brazil. I mean, probably the best investment you could have done last year was investing in the Brazilian stock exchange. You would double your money in dollars. And Brazil is a continent by itself. And then Colombia. Colombia is complex. I can't speak more than 10 seconds about Colombia. I don't fully understand the dynamics of the country. You know it better than myself.
I was there for 32 years and I still cannot really get it.
How about a little bit closer to home, maybe something that's easier or more difficult to understand, depending on your view on politics these days? What does the U.S. political sphere look like in terms of the impact on real estate for those of you who invest closer to home?
Okay, so essentially we are very interested in analyzing the dynamics of fear, you know, because what really happens when you have Brexit and then you have Donald Trump and everything going on in the world, you know, the underlying issue is fear. And we have seen how it has shifted the way people are perceiving investment opportunities. In our case, we are trying to move away from the traditional top-down model in real estate financing because we understood that we could, under that model, only build what we could finance. And that was very limited, you know, and driven by fear, of course. And we're evolving into building things that the crowd wants to be built. And by doing that, the crowd is looking for capital preservation. Because the first thing that you do when you're afraid, you know, is to protect your assets. And if you reflect on that for a moment, from a global standpoint, for a smaller investor with liquid assets probably between $200,000 to $500,000 right now, which is our market. We're trying to bring it down, you know, a couple of notches, but right now we're at $200,000 to $500,000. Where would you preserve your capital from a global perspective the most? And that's why we focus mostly in New York commercial real estate assets. So understanding fear is really at the core of our strategy, because that enables you to take it a notch higher, you know, in terms of the real estate we do. What is the second thing that people want to do when they're afraid? They want to come together. loneliness is a nasty feeling, when you're afraid. So communities, clubs, co-working. So we're very interested, in that space as well. So we're focused in New York in trying to build and deliver products that make sense, with away from the traditional top-down model and away from the typical restrictions. Because we found as well that traditional institutional capital was not aligned with the long-term component of the real estate. We have seen, that there's no such a thing as bad real estate. You just run out of money. So that's essentially how we view the current political situation.
Christina, I'm sure you could give us a semester-long course on what's going on in Asia and how that's impacting your investments across the world. But could you start with Chinese capital controls and how that's affecting your business, and then what else you're seeing in terms of geopolitical risk and things like that in your neck of the woods?
I actually wanted to start with a little bit of the Chinese politics, so to speak, because since everybody kind of went around with their politics of their country. So China is very interesting in that I think because we live in it every day, so we are seeing the changes happening. And I worked in investment bank prior to joining Gall Capital with my brothers. And throughout all that time, China has gone from clearly a communist country to basically when they start the first reform was the state-owned enterprise. So it was all about streamlining the government-linked companies to be more efficient, more competitive, and thereby obviously able to offer more jobs. And it goes from obviously industrial to manufacturing. Those was the beginning of the reform. And then it gets to the service industry, which was kind of happening probably in the last, I would say, 7-8 years already, where the government is moving away from pushing low-cost manufacturing in China, but moving those towards a service industry. So it gradually kind of improved the skill set of the citizens, okay? And with the ultimate goal, of course, to enhance the wealth of the broader economy and its citizens. So generally, I think it's actually working quite well. If you look even 10 years ago, it has already achieved a lot of those milestones. And I think currently what we are seeing in China, it's to us even more exciting, is that the technological advancement. Sometimes I look around the world, clearly I think US is still the place where innovative technology or ideas still is showing the most strength. But China is actually extremely good at taking a lot of those initial ideas and further proliferating it, adapting it to a far more kind of, I would say, supergiant way. Of course, it's because of its population, 1.3 billion of citizens there. But it's clearly that, for example, I look at WhatsApp, I'm still using WhatsApp every day. But in China, it's called WeChat. And of course, all of us know WeChat has already proliferated to, you basically is like living, you're paying, you are doing mortgages, everything is on WeChat, which WhatsApp doesn't have that power. So if I look at, of course, the two giant internet companies, Alibaba, Tencent, they are growing leaps and bounds, in terms of their earnings every year and their business reach to each of the citizens. So to us, I think that's actually very, very exciting because it also shows that going into the future, China remains to be very exciting. And of course, the broader Asia is drawn from a lot of these China wealth, be it tourism industry, obviously consumption type of businesses. Mobile apps proliferation is actually the farthest along in China. And in fact, some of the best private equity companies that came over to Asia, visiting China on purpose, they were saying, in the US, we started off first and we grew very big, very rapidly, but now our China China branch, for example, is actually driving the business because their mobile apps adaptation by the citizens. It's so amazing that these private equity companies said when we go back to the US, we actually need to figure out a way how to enhance the mobile app user base. Right? So I think all of this, it's very exciting for us. Now, we are a real estate company, but we also need to continue to evolve. So I think the way that we have tried to keep evolving by doing what we do best in real estate is to, and a lot of times, partnering up with these sort of technology companies, where as they go into different businesses, they are collecting big data which big data is extremely useful in, of course, predicting the user behaviors and how to push different kind of products into them, because we could, from big data, we derive what people like, even including office space, for example. So we are able to, for example, right now working on an operating company which needs real estate space. It's kind of similar to a co-work space concept, but we're dealing with doctors. So we realize that there are a lot of Chinese doctors that they are no longer operating in one doctor, one clinic operation. They're actually going around different parts of town to see patients, and then they would book maybe 1 week long of surgical time in the hospital. So they're going around actually leasing office space. So we realized that. We're like, okay, why don't we provide the real estate space while the technology company, who obviously were having these apps, provide the users, because they obviously have the database. So we're kind of moving along with times as to how we could work more efficiently, even though we are, after all, a real estate provider. But we would do, of course, all the renovation and fit out and all that, facilitating the user base of the future. Yeah. So.
How are some of your other investment strategies in terms of property types changing with an eye toward technology and an eye toward changing demographics, as Christina mentioned? Roger, could you walk me through any of that?
Yeah, well, I think that we're having a very close look at retail, which I read a lot about in terms of what's going on in the UK, but we're having a similar issue, certainly in the UK, with some of the department stores who are now under a lot of pressure, whether it's Marks and Spencer's or Debenhams or whatever, and they anchor some retail malls in the UK, and they, I think, probably aren't going to be around in their existing form in 5, 10, or 15 years. So you've got to ask yourself, how do you really combine leisure with a retail mall to make it viable over the long term? So we own a lot of malls, and the ones we own, which are B grade, we're trying to get rid of. And the ones that we can, we're trying to introduce leisure into them to ensure that they're viable going forward. Logistics is an area that, again, is hot over here. There have been a number of companies that have been formed in Europe to deal with this, and we're focused increasingly on that because it's an asset class where yields have probably moved 300 basis points, maybe 400 basis points in the last 3 years from where they were, which is maybe 8.5 or 9% down to 4.5 or 5% to manage distribution centers. So these are areas that we're focused on. I mean, office is a bit more complicated. You got the dynamic WeWork, who's they're in Berlin, they're in London, they're everywhere. I haven't been able to see a balance sheet, income statement, or flow funds from those guys. So we've turned down opportunities to pre-fund them as a covenant because I just maintain some doubts about their long-term viability as a company. And I'm not saying the concept won't exist. I think it will, but they haven't withstood a recession yet, and I suspect as and when one happens, maybe some of the kids who are working there may end up in their parents' basement, and not paying the rent that we work.
That makes sense to me. I was talking to a prospective investor 2 days ago, and he basically said, how the hell do you underwrite a property fund for something like this? It's just too new for us. So that makes a lot of sense. I think a lot of people want to see how these space as a service industries can actually weather a storm versus just survive the post-recession bump. Have you seen that in New York much?
Absolutely. I have to say that that's precisely the point that is of interest to us. And let me try to illustrate it with an example. In Bogota, there are 10 million people living in this city. The commute became impossible to manage. And there's 1.7 million people living everywhere in the city, and they work in downtown. So the solution is to bring them, one of the potential solutions is to bring them to live downtown with the right conditions of livability, walkability, so that they can work there and live there and go to school and so on and so forth. So the issue is that in order to do that, you need to do skyscrapers. So in a skyscraper, for a skyscraper in a country like Colombia, where you have the country risk, where you have devaluation, you would probably take $300 million capital stack. Let's say that you would get a senior loan, in dollars, probably close to what, 180 to $200 million. Pick a rate, and then you would have some junior as well, piece, and probably $60 million in equity in the deal, okay? Based on the analysis that we have done in that traditional model of financing, the developers are going to be washed out, no matter what, It's no wonder that the last skyscraper that was built in Bogota 40 years ago bears the name of a bank called Patria, in the front. So in order to really innovate in real estate, we need to change the way we understand how we finance things using technology. Because it cannot be, that real estate is the single asset class other than sacramental marriage that hasn't changed, for the past 100 years. That doesn't make sense. What if we think about, maybe a building pops up, we say, why don't we get a source of financing that wouldn't get a preferential return so that we can finance the building at zero cost because it's too risky, and the 3 years may go to 4, may go to 5, okay? And then in exchange for giving us the money at zero cost during construction time, we will give them a preferential return or a pro rata share on the cash flow that the asset will generate. What if you can find an investor that you can talk to and say, okay, we want to build this building. We know that the cost is $300 million. We don't want a senior, we don't want a junior. Why don't you put up all the money? It may take us 3 to 5 years to build it, because it's very challenging. But after that, whatever cash flow the property generates, we'll split, we as GPs and you as LPs, okay? That is crowdfunding. We raised $220 million for the first skyscraper in a generation in Colombia with a developer from Spain. So it is not about the real estate. It's about the way we finance the real estate so that we can then innovate in real estate. Apply that to hospitality. Ownership is the ultimate reward program. I was in the Mandarin in Barcelona, and they gave me 11 towels from every size. They don't know how to pamper the clients anymore, so that they keep coming back. From the moment I get there, on the taxi, to the point, that I'm in my room, 4 to 5 people offer to help me with my luggage. We don't need any of that, okay? But if somebody tells me that I can own a piece of that real estate, I'm telling you that I would never go to any other hotel. So we need to change the way we understand real estate financing, so that we can really get creative on the way we understand how to build things.
I have an interesting audience question that relates probably a little bit more to my vacations than my real estate strategies, and that's with 2 interesting markets in the Caribbean. I'm not sure that anyone on our panel has invested there, given difficult exit strategies and things like that, but just thinking about Cuba and Puerto Rico, 2 places with very different sets of problems, how do you feel about investment in each? Is there institutional capital there? Is there crowdfunding capital there? And what do the futures look like for each of those places in terms of the real estate?
I have to tell you that on one side of the spectrum, we get very creative understanding the nature of the portfolio of our investors. If you think about it, somebody with probably $100,000 to $200,000, which is where we want to go, willing to invest 10% of that, $10,000, in real estate. That is the creative part. Facilitating through technology, the KYC, the AML that happens instantaneously, and you can provide that guy access to real estate that otherwise he would never have access to. But on the other side of the spectrum of that equation, we need to be ultra conservative, So I have to tell you that I wouldn't touch Puerto Rico or Cuba with a 10-foot pole.
If anyone's interested in institutional investing there, let me know, because I would love to write a story on it. Christina, I have a question for you based around institutional capital raising, and then Roger, maybe you can follow up. GAW has been rocketing up the very famous Perry 50 list in terms of the AUM and value-add and opportunistic funds that firms across the world are raising. So from your perspective in the fundraising world right now, are you seeing a push for separate account mandates more so than interest in commingled funds? What does the kind of delineation look like in terms of institutional interest in partnering with your firm? And maybe for our non-private equity real estate folks, you can give us an overview of what a separate account is and what a commingled fund is.
Sure. So it's good because I'm in charge of capital markets, so it's all fundraising is all my area. Well, there's quite a bit of a development in terms of the capital stack, as in where are the most capital coming from, at least into my business, which I think we have about 13 billion of AUM now, US dollar, and half of that is actually our Asian business, which are mostly commingled funds. And then we have something called separate account, which could be defined as someone giving you an amount of money, say a couple hundred million, and to give you some defined criteria of what they're looking for, and then you basically look for things for them. So that's a separate account. But the way we define separate account in our firm is that since 2010, we have actually started buying individual assets, which are trophy type, usually, in key gateway cities around the world, on behalf of a lot of our Asian capital. So we're acting as advisor as well as asset manager post-acquisition. That we call separate account as well, because it's actually identified one by one. And then we also have a very creative type of strategy towards US, which is also a blind pool vehicle. So we have sort of those type of businesses. Now, business lines, product lines. And in terms of the capital, back in the days when, in 2005, when we first started the business, 70% of our LP base are in the US. So there are the fund of funds, obviously, and the endowments. And then growing into the last 5 years, there's a significant increase in Asian institutional capital, especially the Asian sovereign wealth funds. Clearly because they're moving from a traditional stocks and bonds exposure to gradually increasing their exposure to alternative investments. And then, of course, later on realizing that having stable assets, giving them income over time is actually a very good way of balancing. That's why, and because these are sovereign wealth funds, so they took a bit of time to do research and deciding to move. But once they move, then it's actually very sizable. And in addition to that, we also have quite a lot of insurance companies in China, which, as many of you know, are very, very big and have high liquidity. So I think I owe an answer to your earlier question, which is the capital control from China, which actually is affecting quite a bit from these big institutions. There are still corporates who are active in buying things overseas because they have overseas businesses, for example, in Hong Kong. So their money is already parked outside, so they could definitely use that. But for a lot of these big institutions like insurance company, they're definitely having a slowdown, as you would have realized. In the last 2 years, or 18 months at least, there's not as many big names making acquisitions like they were before that. This could change, okay? We do not know when it's going to change, but RMB is pretty stabilized now, so it could change. The Chinese government could move fairly quickly. But in the meantime, it's driving up the China real estate prices as a result, because when they cannot buy overseas, they started to buy onshore. So we're monitoring it pretty closely, but I would say that the capital flow in Asia going into the real estate as an asset class remains to be very positive. So I think from 2005 to now, my investor base have changed in terms of 70% would be US, 30% would be rest of the world in the early days, to now very evenly split of 1/3, 1/3, 1/3. Asia, US, Europe, plus the Middle East, and so forth. Yeah.
Roger, separate accounts, commingled funds. What is institutional interest looking like in Apollo's vehicles right now?
We do both. I think, as a maxim, the larger the pension funds, the more interested they are in going direct or doing separate accounts. And I think for two reasons. One is cost. So if they invest in a fund like ours, there's often two levels of cost. There's the cost of us, which is 20% above some hurdle rate. And if we then turn around and find an outside partner, that's further dilutive to their returns. So if they can find some partner in in Mexico or in Germany that they can do things direct with. It's just a bit cheaper. The other thing the larger funds, I think, like about separate accounts is duration. So our funds are limited life, and sometimes that coincides with the right time to sell because you're selling in 2006. Sometimes it coincides with the wrong time to sell because you're forced to sell in 2009. And if you've got the ability of a separate account or a co-invest to sort of ride yourself through that, then it's easier. If you're from my home state, Missouri, you're not really left with the opportunity to set up an office in London and buy 500 million pound properties. You've got to go with a fund, I think, and probably one that's got a strong brand, because you're only going to put 50 million bucks into a fund. So to some extent, you're limited by your size. And if you're an individual investor, yeah, you can do deals where maybe you're buying an apartment building in Phoenix and sticking, $1 million in, and you may know the guy that's doing it. That may get you comfortable, but there's also something to, we have a large sleeve of investment from JP Morgan, where they've gotten their large private wealth clients to put $5 or $10 into that vehicle, and I think they're doing it because that is JPM, because it's Apollo, and they know more or less what we're going to, we've been around for a while, and we're going to be good fiduciaries, and they think they're going to get the money back with a return, and they may not have an opportunity to, or may not know someone in Phoenix that might be the right market to invest in.
I just have one thing to add to what Roger has to say. Co-investment is actually an increasing popular way to, at least for my part, to get investors into my blind pool funds. Actually, most of the big capital prefer to go direct, but then they also over time realize that from resource constraints perspective, it's very difficult for them to move very quickly because they're a very big organization. And so in order for me to get them into my blind pool fund, I would say if you're my LP, I'll offer you obviously a priority look on co-investment opportunities. And by co-investment, it also allowed them to put more money out, but actually cheaper, because as a GP, I would offer discount. I still charge fees and promote, but it would be cheaper. So that has been actually a very successful way for us to get bigger capital into my blind pool fund. So it create my bread and butter business, but while offering them, extra opportunity on the direct front. Yeah.
That makes sense. Lise, how about you at the end? How's your investor base changing these days? And are you accessing any new pools of capital?
Yeah, well, we have basically 4 sources of capital. One is our own balance sheet. We are a 50-year-old company, long term. Then we have a strong position in REIT with international investors for commercial real estate. We do JVs with funds like the ones who are sitting here. And then we do like small clubs of, let's say, 5, 6 investors. We take 30% maybe of the equity for a specific type of assets. I don't believe public markets are the correct vehicle for development. And I say that because there is a growing amount of land banks in Spain who are being public with a big success. And they try to sell it like a factory of all kinds of assets, especially residential. I don't think development of residential is a factory, and I don't think the proper way to fund it is through the stock exchange. I prefer the private model. But for commercial real estate, like that, the one we are the second biggest owners of shopping centers in Spain. It's a long-term business. There is some rotation, but on a moderate way is a long-term view, value creations through some skills and asset management with a high dividend ratio. I think it gives you the long-term view for something that is basically stable and I think it's correct, but not for development for sale at all, which you need to be prepared, and I have a lot of experience in that, coming from 100 to 10 in 6 months. And that's not something that is suitable, I think, for public markets.
I would like to say that when we started with the crowdfunding model, we were the first ones in New York, and loneliness, like we were saying, is a scary feeling. And now that everybody's talking about it and everybody's realizing that it is more than financing iPhone gadgets in Kickstarter, we already have probably $1 billion in a portfolio in New York, and we have raised close to $400 million plus in equity, in common equity in all these countries. And the most interesting thing is that I thought that I would be antagonizing with traditional institutional sources of capital, when it was completely all the way around. Because what happens is that because we're very conservative on the type of real estate we do, as fiduciaries, with the crowd, we are perfectly lined up in the type of assets we like. The thing is that I don't have the restraints that Roger, for example, was explaining about at the exit. That is normally 3 to 5 years, correct me if I'm wrong. So, but I don't have also the money, to tie up a deal. Because a landlord in New York or an owner is not going to say, okay, you know what, this is a $150 million building, we like it, why don't you go ahead and do your thing, and then you come back in 6 months and give me the money, and I work well here for you. So what I do is that I partner up with, obviously, senior lenders and pension fund administrators. We analyze the assets, we like them, and then we buy them together. Some sort of the GP, we share it with our own equity as well. And then I have the time to take you down to a point where you're comfortable in staying. So your exit somehow is you could say, guaranteed, by our capacity of bringing the long-term capital that the crowdfunding entails. Because if you put it in perspective of what they are looking for is capital preservation in the long term. They don't have the restrictions about the exit. So that has been, an incredible compliment, for both the crowd, us as sponsors representing them, and institutional investors. We work with the Corman family, which is one of the most established developers, in the region. They have been doing business for 100 years. We are buying our third project together, and it works extremely well for both of us because they provide the certainty in the execution that I need, that makes me feel comfortable so that we can bring the crowd into those deals. So it's been a very synergistic relationship that enables us to do deals that otherwise would be very difficult to do.
I have quite a number of questions from the audience, so thank you for sending those in. So we'll try to go through these rapid fire so we can make sure we get through as many as possible. Question, very local. What are your views on Boston as an investment market? I think, Roger, you told me you were here 2 or 3 times a year. I'm not sure that many others of you actually invest here, but if anyone has some thoughts on the local market, I would love to hear that.
I come here to shop, not to buy, but...
To run the marathon, right?
Yeah, and run the marathon. I'm actually a St. Louis Cardinal fan, so I've been disappointed the last 2 nights in the results of the baseball games. Look, I have to confess, I don't know a lot about Boston. It seems like it's intriguing to me for a couple of reasons. One is the educational facilities. The MIT, of course, is great. There are other great institutions here. I think anytime you've got a young, dynamic base, when I think about investment anywhere in the world, I always look at that because I think that's quite important. And secondly, it strikes me next to Palo Alto, you're quite a rival of Palo Alto, certainly in terms of the biotech sector of what we've been talking about thematically, which is technology. And when I think about investing, it's technology, it's population growth, and the third thing, one of the reasons I like Europe, is planning restrictions. So I think all these things combine to be pretty interesting place to be making investments today.
We've talked a lot about equity here on stage, and I had a question on debt, which we also all talked about on our prep calls. The specific question is, do real estate debt funds fear the impact of changes in the banking sector? And another question to kind of go along with that is, how attractive is debt relative to equity right now in the real estate space? Any thoughts on that?
We're starting. We have done equity up until now, because I believe that the smaller investor has been so beat, by the premise of small return in exchange for a small risk that didn't happen. They were pummeled, facing massive risks, and the return wasn't there, of course. That they are very interested in taking as much risk as they can, with their tickets. But now, as they learn more about the opportunities that this entail, we have seen a growing appetite for debt. So we're launching our first debt offering very soon, So and we'll see how it goes. But I believe that there's a big opportunity as well in crowdfunding for debt. We want to be positioned in a couple of years as the cheapest junior financing provider, in Manhattan, based on the crowdfunding that we do. However, for that one, we would have to change our model slightly away from specific asset crowdfunding, because in our model right now, every investor can pick exactly the asset where he wants to put his money. And I think that for the fund, for the debt piece that we want to put out, it would have to be more fund-driven. And I'm interested in understanding whether the investor is willing to pool the funds, just like institutions do for the debt piece, So I guess we'll find out very soon.
Well, there's definitely increasing appetite from the Asian institutions to do more debt on real estate. In particular, we have been fairly successful in the last couple of last year, actually, to do mezzanine debt on certain real estates in the US and in London. Of course, we are just starting in that space, not to compare to Apollo at all, but the appetite from some of the institutions like in Korea, definitely growing interest, and I think the Chinese ones are looking to get into that space, hopefully not too late.
You told us to be provocative before, and for me it's clear that in Europe, debt is cheap, incredibly cheap. I mean, a normal REIT will give you a dividend yield of 5% in Europe, and you can borrow at 2%. I mean, it's a market that it's not a real market. It has been manipulated, and it's out of the question to me that the more you can take, the better. It's a no-brainer.
It's free money.
It's no discussion about it, in my opinion. Then Latin America is different. In Latin America, I will think it more in terms of expensive rather than cheap. I mean, where's the point on taking a loan in Brazil at 16%? I mean, how can you make any money there? It's impossible. I mean, or you have to be crazy.
I couldn't agree more. We went in Colombia that's the thing. It's impossible to develop like you're saying. How can you get? In Colombia, it went from 9% to 16, 17% in less than 12 months. You're dead in the water. So that's why when we are in emerging markets, we have only done it in Colombia until now because we're really focused in New York, like I was saying. We build with no financing. And the crowd provides all the equity, and they buy into a pro rata share of the cash flow. That's it. And they exchange the fact that they don't get a pref return over the time of construction with certainty because they don't have anybody in front of them, which is something that in a market like that, precisely because of that interest rate, that is a sort of security that they would never have. They may sacrifice 3 years of yield, okay? Hypothetical yield on top of everything, because it's pay and accrue. But they will never lose the asset. They may make more money on the rent or less money on the rent, but they will never lose the asset. So that's why they invest.
Couple quick questions on technology. One that makes sense given the recent news on cybersecurity. What are your firms doing, and maybe you could have one or two people answer this, on the cybersecurity side, protecting your own firm and then making sure all your LPs and all of your investors' information is quite secure as well within your firm and any third-party vendors?
Wow.
For more on this, I have a great story out from our CFO's conference yesterday. So if anyone is interested in this, you can follow up with me for some tips from CFOs themselves. I know that's a pretty technical question for people up here. A better one might just be, what have you seen that hasn't worked on the technology side, whether that's for your tenants or internally? We talk a lot about innovation and had a great panel or a great session just now on 3D printing, but I think sometimes we miss some of the opportunities to learn from our mistakes too. So Luis, I know you had mentioned one thing that hadn't worked on the residential side for you on our call. Could you explain that for the audience a little bit?
Well, what I was trying, I mean, I have to be cautious to speak about technology in this place. And technology, of course, is extremely important. We believe in it. We spend a lot of money on it. It is affecting a lot of our business. It is a social driver for opportunities and threats. And I think that one of these inequality that is affecting all our countries and also this industry, because at the end we build things that people live, is because of this technology tide. But what I was saying is that till now, as far as I know, and I might be wrong, technology hasn't been a driver of competitive advantage in the development of housing. Others have been, but not that one. And specifically, in the product that we built, very little. We built basically in the same way in the last 25 years. The structure of the building is almost the same. The materials are not so different. We are as old-fashioned as we were then. And when we have tried to go a little bit beyond that, at least in the countries that we know, the customer hasn't paid for it. And when we have tried for the affordable housing, complex things that try to build like in a factory to make the cost lower, like in Mexico, at the end, the traditional manufacturing process of the last 25 years has beaten us. That was my point.
I would like to say quickly a couple of things relative to security. You know, I have to say that collaboration is the key. You know, you need to know that you only know what you know. And I confess my ignorance when it comes to certain aspects of technology. But you can always find, in places like this, and the team we built, you know, with experts from different banks that we took from the technology side, the top technology protection that enables us, for example, to bring clients together and do KYC, AML in literally seconds. So that is the disruption that I see in real estate. Disruption in real estate through technology, aside from the community work, aside from facilitating, you know, booking a conference room, you know, through your app, will come through the disruption in real estate finance. Because our goal is to truly bring the ticket down to as little as $100 if we can. So imagine somebody anywhere in the world buying commercial real estate in Manhattan now, and then in other locations where it would make sense, with as little as $100. So that is where the innovation will kick in.
Christina, I know that you're seeing a lot on the tech front across the world. What is top of mind when you're thinking about leveraging technology in your business?
Well, you know, as I mentioned earlier, I think I agree with Rodrigo, is that we're very good in doing real estate. We are also very good in analyzing the user trend of the future and try to make sure that our real estate, as we reposition them, is actually suitable for the use of those people. But we are actually not a technology firm itself. So therefore, collaborating with, as I made some examples in earlier time when I spoke, was really kind of what was unique in a way about us. Because in a way, we're actually creating new tenants out of these sort of collaboration with technology companies in how to better utilize their data that they have collected, and think of these new creative space that could create a new tenant. And that in the end would actually make our asset more unique than the neighborhood one, right? Because they don't have those kind of tenants, right? So I think that sort of, it's what is taking us continuously on the forefront.
On the hospitality side, I had a question on Airbnb. Are you afraid of Airbnb? And this could be either on the hospitality front from this question or actually from the multifamily side. I've talked with a lot of some of the biggest landlords in the country who are worried about the security of having really short-term leases or having people stay overnight that they haven't vetted and haven't gone through a background check. So as you're looking around the world at all of your properties, how much of a threat is Airbnb, if at all, or does it register?
That's a very good point, because we do short-term rental buildings in Manhattan. That's one of our asset classes. The other one is collaborative workspaces. And we embrace technology, and we understand transformation. And we believe, that Airbnb is here to stay, whether we like it or not. And so we decided to build, one of the first Airbnb buildings that is fully legal. Because what scares me about Airbnb, and I tried it when I go to Colorado a couple of times, is the sense of safety. You don't know whether it's going to be safe. You don't know whether it's going to be clean. But if you embrace Airbnb and you develop an Airbnb property, for example, okay, it could be an incredible partnership. I'm developing 81 apartments now, short-term rental apartments. It's R1, which effectively enables me to rent them on a nightly basis. And I want to Airbnb the whole thing. I don't need to deal with the whole branding issue whatsoever. And as long as I can provide a cleaning service, and as long as I can provide security, I think that people are going to prefer renting one of my apartments than a mom and pop, that is going to be competing against me. So that is the sort of flexibility that we thrive about. We need to adjust.
How about autonomous vehicles? Has that factored into any of your thoughts on how to design parking garages or the spots that a multifamily property might need or anything like that? I know we're still pretty far off on the self-driving car front, but any preliminary thoughts on the impact on real estate?
I think it's going to be massive, but I think it's also impeded commercially by indigenous issues. We're still, Tesla's the rage, and it's got a larger market cap than Ford, but it's still sort of a car. It's not an autonomous vehicle car, and you're going to have Tesla's going to be fighting unless they crack the code, the autonomous vehicle. I think this is a 20-year thing, not a 5-year thing. And of course, in London, we're still using horse and buggy, so we don't have to worry this. But I think it's. All the change is good, whether it's Airbnb, whether it's autonomous cars, and more importantly, we got to live with that and adapt to it. When I think about London, which was laid out by sheep, it'd be great to have a simpler way of getting backwards and forwards with fewer cars. And as far as I'm concerned, the fewer the better, And if we can make it more efficient, that's great. It will mean that some people are going to benefit from it, some people are going to lose from it, but I think it means also that cities ought to be more livable than what they are today. And we're not really shying away from investing in parking garages today, but certainly when we think about that as an asset class, we're looking a lot more at what alternative uses are for that than what we ever would have in the past, because there's no doubt in my mind that this will be something in the next quarter of a century that probably will make a profound impact on how we live and work.
We're going to, go ahead.
Yeah, I want to say that one of the biggest challenges, in my opinion, for the Latin American cities is public transportation. It's absolutely dreadful, the transportation that you have in Sao Paulo, Bogota, Lima, big cities. and unless they do something about it, they have a real problem. And one of the problems from the perspective of a developer is that the amount of parking lots that you have to build, not only for legal requirements, but also for commercial requirements, is completely absurd. I mean, you need to build 3 parking lots for an apartment. Yeah. In a place like Mexico, with a soil which is dreadful. And sometimes it's more expensive to build the car park than the actual building, because to dig there is amazing. I mean, we have we have more engineers in Mexico than any other place, because it's so difficult to do it. And I think they have to do something about it. It's amazing. In Madrid, I don't have a car there, obviously. I take the underground all the time. I've only been once in the underground in Mexico because I wanted to know it, and I will not return probably. And I haven't been in Sao Paulo, the underground yet. How can a city of the size of Mexico and of the size of Sao Paulo survive without a good public transportation? It's out of my mind. And now there are elections in Mexico City, and I am amazed that the candidates, when they speak about it, it's not the biggest issue in the elections. It's like it is take it for granted that it will be like that forever.
I wanted to take a quick trip around the world because we have quite a few questions on property-specific questions around markets. So if we could spend maybe 30 or 45 seconds on each country. I think I have 5 or 6 different questions on different markets. So let's start with Argentina. What's going on there in terms of opportunities, and what are we seeing down in quite a big market, but with not a lot of institutional interest at this time?
You're not asking me, are you?
Oh, anyone who's interested in Argentina.
Argentina for us is an incredible market because they love New York real estate. But I have to tell you that from a property perspective, the whole change that everybody was talking about, a few months ago hasn't happened yet. It's in the way. It's on the way. It's people are very optimistic about it, but I wouldn't look at Argentinian real estate.
How about Sydney? Christina, does SCOG do anything in Sydney right now, or is it just too heated?
We do. But I think more interesting is I do have to add something on the technology front, because I was going to say that even though at GAW, the partners are not necessarily technology geniuses, especially we're sitting at MIT, with a lot of alumni who are very much into that space, but we actually are creative enough to appreciate the creative minds. So a very big thing about the GAW culture, company culture, is that we love to attract the smart creatives. They don't necessarily have to be an innate real estate expertise when they first join the firm as a young person, but clearly most of the people relate to real estate because it's actually quite easy to understand. But then if they add on all these new ideas, we appreciate it. And then we ultimately have a platform that could support them. Because I think I have also come across from networks, come across a lot of very creative young people that have ideas related to real estate. When you're talking about Airbnb, there's already companies in US startups where they are tackling the unused rooms of hotels on a day-to-day basis. Immediately, as you need something for a couple of hours and all that, you could have an app to find it. But a lot of these startups have great ideas, but I think it's sometimes rather difficult for them to scale. So I think the great thing is we actually relate to those kind of new ideas, and we have a platform to provide for them. So that's actually, I think it's a very good thing, so that we could continue to stay on the forefront. Now, going back to Sydney, we actually started to have some investment in Perth, of all places, because we could get fairly distressed commercial assets where we could turn into, interestingly enough, student housing. Because there are obviously quite a lot of universities in Australia, and there are a lot of Chinese students going to Australia if they couldn't get to the US or the UK. And so there is a demand, demand shortage there, supply shortage, sorry. So we actually bought a very distressed commercial real estate as a result of Perth basically being affected by all the natural resources and those businesses downturn, and we were able to buy it and convert into student housing. So we are trying to use that as a test case and build it along. We have to be quite specific on what we get into for Australia. We're also doing logistic assets there as well, starting to. So that is our recent entry into Australia, basically.
Great. Luis, could you give me 30 seconds on market opportunities in Spain right now?
Apparently there are many, according to the amount of money that is floating there.
A lot of opportunistic capital and core right now. It's really interesting.
Well, the news of the month are these land bank vehicles that have been formed recently by funds like Lone Star or Barde, with very, very small track record that they have been launched, and they are trading at a premium on NAV. That's the latest news. But money is getting in an incredible pace. Commercial real estate, meaning shopping center, not shopping centers as well, but especially offices and logistics. Cap rates are, I don't know where they will go at the end. They get lower and lower. Definitely about 4% for offices. So the atmosphere is very upbeat. And on the residential side, the amount of purchases by foreigners. I mean, now in Spain, for every 4 houses or 4 apartments that are sold, 1 is purchased by a foreigner, mainly European, which are floating to Spain. And in the hospitality sector, and comes to be that I am in the board of a company, of a big hotel company called Barceló, and the Canary Islands used to be a declining market for years, and now it's booming. So there's always a good part of bad things, and in this case, all the turmoil in the Mediterranean has been a blessing for Spain. So the only thing I can do is say is that I am astonished how things have changed in just a couple of years. I can't believe it, and I hope it will last forever, but it won't. Unfortunately, it won't.
Rodrigo, closer to home, what are you seeing in the New York commercial office space right now? Are pension funds still interested? It's a really heated market right now. So what do you see in terms of the opportunities and the future for office space in Manhattan?
I have to tell you that I do believe in the transformation of a good chunk of the office space. I believe that for as much as it could decline when the economy goes down, and you will see the kids. I agree with Roger, going back to their parents, when their startup didn't work. I also think that people are understanding the power of collaboration. I clearly see, the society taking a stance away from individualism. You have seen, the good thing about our current president is the reaction that our current president created. I think that the pink pussy hats are absolutely fabulous. And I believe, that it is bringing people together. So to me, anything that facilitates community makes sense. We're very excited with a project that we're about to launch. It's called The Assemblage. We're essentially away from individualism. We are bringing together a community of people who believe that we are all one. And it is a co-working, co-living, and social event space, with 3 buildings. And I think that it'll be extremely successful, and it has already a pent-up demand for that. Because people do want to come together and figure it out what to do, with the state of society today. So I believe that anything associated with bringing people together to really rethink what's going on in the world and manifest in a way, that makes sense, away from finger pointing, is going to have a strong footing. And I believe that any real estate asset that banks into that is going to be extremely successful.
Christina, someone wanted to go back to your point in the very beginning about the domestic Chinese market right now, that it's become quite heated. And so from your vantage point, do you think that there's a property bubble that's about to burst? Or what do you think will be the future of kind of mainland China and institutional real estate interest there?
Well, I think whether the bubble is going to burst, I think it's more about looking at how the valuation is like around the world as a comparison. So I do not think that it's about to burst because it is kind of at the same level. If you're looking at a core in a prime city, core office, for example, it's at the same cap rate as what you would be selling in London as a super core or New York City, for example. So I think you kind of have to balance things that way, to see whether the valuation-wise is actually a bubble. Hong Kong it's quite interesting in that I don't have as much comment or as much confidence as to say that whether that huge premium to any other China city right now that Hong Kong is fetching can actually sustain. That I do not know because before we came into the room, Roger and I were just talking about a huge land auction that was just announced 2 days ago, which is making the news all over the world because it's actually a car park. And of course, it's going to be redeveloped, but it is actually being sold on a land value basis for 50,000 Hong Kong dollar per square feet, which is about 6,000 US dollar per square feet. This is just buildable space cost. Haven't even completed anything yet. So you can imagine how much it has to sell after it completed. It is at a prime site. So now that is at a huge premium. But if you talk about Beijing, Shanghai, on a relativity basis, being a very key China city as well, is actually not an issue at all. Beijing is 3 times less than Hong Kong. Shanghai is probably half of it. So that's kind of how we see things.
What about outbound capital? Do you think with capital controls and everything like that outbound capital flows will recover?
Going out?
Yes,
yeah?
out of China.
Well, it will. I think the demand is still there to them wanting to buy, and a lot of groups are looking at hospitality assets, interestingly enough. But they do have to wait for the regulatory, standpoint, which is something we can't control. But we know that the interest is there, and they continue to look out for opportunities.
Continuing our world tour, we're heading back to Europe for a question for Roger. Thinking about NPL practices in the European debt space, maybe could you define the NPLs for us, tell us what the market is like, and talk a little bit about Italy in particular. I know
Sure.
that's of interest for a lot of PE shops right now.
Sure. NPLs is the acronym, I assume everyone in the room knows, for non-performing loans. And post-crisis, we started in gorging on NPLs in Ireland and the UK, and the reason to do it there is the rule of law is absolute. And so if you miss an interest payment for an hour, you can foreclose, and the rule of law is very clear. You can take over the asset and get immediately to it and squeeze out the equity position. So we were the first into Ireland buying Lloyd's loans, and then bought a lot of other loans, and most of these were commercial properties, and then we moved on to the UK. As you get into Europe, it's sort of the great divide. There's the north and there's the south, the same way there is in America. The north is pretty favorable to landlords, whereas the south is, rule of thumb, far more favorable to the borrower. And Italy in particular is really, really favorable to the borrower. So often it can take 10 years to get from owning a loan to actually owning the asset. So over the years, there have been a number of players who have been in the market as the markets waxed and waned. In the old days, before the euro, interest rates in Italy were 25%. They were big in the U.S. and big in the U.K. as well, but it was huge. So a lot of times, when you start unpacking some of these loans, you realize that the interest is 90% of the loan, and the actual principal amount is 10%. So, you're starting out in these strange dialogues with Italian banks who are sort of saying, well, the loan is 500 million euros, and you're saying, yeah, but this is an undeveloped piece of land in the middle of nowhere. That's still a farm that you hope to turn into, a hotel, and we'll pay you 5 centimes. And the dialogue's quite difficult, and when you own them, it's very difficult to get to the assets. So we've been active in Italy. We've bought a lot of equity deals in Italy. The great thing about Italy, in some ways, is when there's no functioning lending market, and in practical terms, there's not a functioning lending market, Italian bank lending market, yields go up and prices go down, so you can buy in at that time. And ultimately, it's like every crisis. Ultimately, the domestic market comes back and the loans start flowing. You can pay a bit more, and we've had great success on that side. To date, we haven't acquired any loans in Italy, not for want of trying, but partly because the bid-ask spread, as I mentioned, is quite wide, and partly because we think it's going to take a lot longer to get to the asset than others do.
We're heading back down to Colombia for our next question, and that was a follow-up for you, Rodrigo. When you were talking about building that skyscraper, why are you interested in new development versus retrofitting something that already exists? Why does ground-up construction make the most sense?
Yes, I would only do, not right now, because the overall economy, and the political situation is very complex, But I think in Colombia, I would only do ground up because of my sources of financing, which are essentially crowdfunding. People are willing to give you, for example, 10% of the total cost and give you, over the following 36 months, the balance of their ticket, which will give you access to free money. And then you give them a pro rata share of the cash flow. That is very safe, And other than that, the moment you want to bring something different in, like a retrofitted project, you would have to bring some sort of senior financing or junior financing or traditional financing. And the volatility in the currency and the country risk would make that investment improbable, for us.
Unfortunately, we are about out of time, and I have maybe another dozen questions that I haven't been able to get to. I can't speak for all of our panelists, but I'm sure they would love to talk to you during the coffee hour. I would certainly love to follow up with you if you have any specific questions for me. So thank you so much for your time, and again, please continue this dialogue with us off stage.
Thank you.
Okay, so that was a terrific morning. Thank you very much to the panel, to Skylar, and we're going to continue the conversation on the break and lunch. You'll get a chance to meet everybody, answer some email, and then we'll be back this afternoon. We'll begin our conversation about Africa, and we'll also be talking more about Latin America, and I'll look forward to seeing you in a little while. Thanks.